I'm slightly bemused this morning why billions of pounds and billions of dollars have been added to global stock market valuations on the back of, I couldn't see anything really. And I saw this price action happening as I was looking at various futures indications over the weekend. Your point, I guess, endorses my confusion really. You're saying complex but not impossible to manage money. It is complex to try and interpret and then extrapolate these kind of moves and then work out what to do, isn't it?
I think the interesting element is the volatility regime is pretty low. We are below 20 on the VIX. The correlation are also falling down, so it makes the life much easier for portfolio managers. So that's maybe the positive side. Of course, we have the complexities. We have many transitions ahead. We have the political transition. We don't know what will be the shape of the fiscal policies coming out in the US, whether it will create a huge deficit and create a backup in yield at the long end. That may be dangerous, that's for sure. We have a lot of complexities when we deal with the China debt, as mentioned before by you, and that's the reality. But the question is, growth is there. You know, it's not spectacular, but we have in the notion of unspectacular growth, we have growth, and China is good at that. China is probably the best in the league of policymakers because they are able to align fiscal policy, monetary policy, and currency policy. So on that respect, we are positive on emerging markets and especially Asia.
So Didier, do you worry about interest rates in Europe going up, about bond yields selling off? I mean, with negative bond yields and very, very low yields all around Europe, the ECB running out of sovereigns to buy. Is this possibly one of the drivers to moving money into the equity markets that just looks so bad in fixed income?
I think the big topic for the last quarter of the year will be the bond market. I think the volatility can be induced by the bond market. And for the policymakers, meeting, this week, like the Fed, one of the key issue is really to anchor the long end. So it's more about curve management than level management. They want to avoid that the curve is backing up and create, a high sensitivity within the bond market because we have a huge duration on the bonds, but also as a spillover effect. So it will be a tough call for the central bankers, but they can achieve it with forward guidance, clarifying the communication, pursuing, the quantitative easing on the part of the ECB, so they can achieve that no problem by clarification.
It's more of the same, isn't it? I think what you allude to, Steve, is where do you go, where do you hide? You've got a market rallying and you don't like valuations on markets. Where exactly do you go? One of your calls, Didier, which has captured my attention, is around commodities as an effective diversifier. You've got some of the rally, I think, that is down to the resources sector today, particularly if you see the outsized performance in basic resources. Would you be buying the stocks or would you be going after some of the spot prices for a strategy here of diversification?
I think, first of all, the commodity now has become a diversifier. It was not at the very beginning of the year because we were in a bear market in terms of commodities and energy, and it has spillover effect over all the sector in the US. But now it's different. I think commodities are not really correlated, with the short-term movement. So from that perspective, it plays a nice role in the portfolio, but also directional. If you look at zinc is pointing towards recovery. You have a lot of action in the agri sector as well. So there is really in oil, maybe we can still hedge up in the $55, $60 level.